Well, this morning's ADP employment report showing the private sector added 41,000 jobs in December, slightly below estimates. More labor market data is coming out tomorrow and Friday with jobless claims as well as the December jobs report. Now, keep in mind the unemployment rate rose to 4.6% in November, which was the highest level in 4 years, and the jobless rate was 4% to begin 2025, and total hiring for the year was the slowest since the pandemic. Now, the Federal Reserve's January meeting is about 3 weeks away, and officials will be watching for Friday's data release. The odds of a January rate cut are low right now and are hovering right at 17%. Well, joining me this morning to weigh in is Mark Hamrick, Senior Economic Analyst for Bankrate. Mark, good morning. Thank you so much for joining me. So what are you watching for, first and foremost, when it comes to upcoming data, in particular Friday's December jobs report?
Well, you hit on the highlights there very well, Remy. Good morning. I think we'll just be looking to see where we stand as we fortunately move past all of the noise that was present in the final quarter of last year with the federal government shutdown beginning the 1st of October, and then, of course, the cancellation of some federal statistical data, as well as the sort of catch-up game that we had to play. And there may, in fact, be some noise in the December employment data in the form of how does seasonal hiring show up. But I would be very surprised if the narrative that's been present for some time has any reason to be edited once we get past the December data, meaning this has been a low fire, low hire job market, and the chill really did settle into the job market in 2025, as you noted. Once we get that December payrolls data behind us, it will sort of officially be the weakest hiring that we've seen in the U.S. in the sense of measuring payroll since 2020, and that is noteworthy.
And Mark, as we head into the new year, tax cuts from the One Beautiful bill do kick in this year. And as of right now, when it comes to monetary policy from the Fed Reserve, 2 rate cuts are expected. But geopolitics is also a factor now. So how do you see all of this impacting employment? And as of now, what is your forecast for the central bank?
Yeah, so some of the things you mentioned there are tailwinds for the U.S. economy. Obviously, having more money going into bank accounts with federal income tax refunds and lower effective tax rates. There is a price for that, by the way, being paid in the form of higher debt deficits. We're putting it essentially on the credit card once again. But it was also where you have to think about the fact this was a continuation of the 2017 tax cut in many ways. The other tailwinds that you referenced there is lower short-term interest rates. But I don't have a sense that while the Federal Reserve has been obviously very attentive to the issues of the potential weakening and actual weakening in the job market, that is going to be sort of the panacea that has Americans dancing in the streets because of the Fed's lower federal funds rate. It's obviously helpful, but I don't think it's hugely significant. Obviously, removing restriction. But at the same time, the Fed has been saying we're getting closer to neutral. So that means that rates have continued to be restrictive. Right now, I don't really want to bet anyone's money on what the Fed will be doing in the coming year because it is such a dynamic situation. We obviously will have a new FOM, a Federal Reserve Board chair, Jerome Powell exiting in May, and that person coming in is seen as likely to be more dovish or more inclined to lower interest rates. But given that that entity is a politically independent body, I think the power of that office can be such that individuals really do understand that they need to also do a credible job and not just be inclined to hit the lower interest rates lever. But I do think there are reasons to be optimistic about the economy in 2026. But as you said, the geopolitical risk meter is really popping right now for all the reasons that have been cited after the events of the weekend. And so we have to acknowledge what we do not know, and that also belies uncertainty, and that does not help confidence either for consumers or for business leaders.
Yeah, and Mark, last but not least, before I let you go, we have about 60 seconds here. So you just highlighted some of the uncertainty facing the U.S. economy. So for viewers out there, Americans who are wondering, what does this mean for their bottom line? What would you tell them right now?
Well, we did a survey of Americans, Remy, asking them about what their outlook is for 2026, and it was really indicative of the so-called K-shaped economy. About a third thought their finances would get worse, about a third thought they'd get better, and about a third thought they would stay the same. But that downbeat assessment is the worst since we've been asking the question since 2018. The number one priority for Americans, they tell us, is to pay down debt. I think that's prudent, but given the fact that the majority of Americans continue to live paycheck to paycheck, they really do need to bolster emergency savings while continuing to fund their retirement savings. This is a situation where, when it comes to our financial goals, we need to be able to walk and chew gum at the same time.
Well, Mark, we will have to leave it there for today, but thank you so much for joining us as we kick off 2026. I appreciate your time and all of your insights.
Thank you so much, Remy.